10th. Happy Federal Reserve meeting day. We got some fantastic, well, news. I mean, news that we all already knew that was going to be happening. We got another 25 basis point cut today announced by the Federal Reserve. But most importantly, what was the conversation after the fact at the press conference with Mr. Jerome Powell? What does the future hold? What does 2026 look like? Do we have projections even into 2027? And then some fun announcements that we'll discuss and talk a little bit about, like quantitative easing and some of the bond roll-off stuff that, again, I don't want to get too deep into the weeds here. There's plenty of other industry experts and in the financial market that you guys can go and take a look at and do some of your own due diligence. Also, I need to get back to work here pretty soon, so I'm going to make this nice and snappy, quick, digestible, all of the above for you guys. That of course like to support the channel. So I greatly appreciate that, guys. Thank you so much if you are here with us. So let's just get right into it. Let me go ahead real quick. I'm going to pop open the chat just in case we have anyone in here that has any questions or wanted to shoot any words of encouragement our way. But okay, so we got the 25 anticipated 25 basis point Fed rate cut. What does that mean? Remember, guys, we'll continue to educate and we'll continue to remind you that any cut from the Federal Reserve is to the short-term federal funds rate. Remember, does not directly correlate to mortgage interest rates. However, when the markets are moving accordingly, okay, and everything is in sync, a decrease to the short-term Fed funds rate, which is the overnight interbank lending, okay, for things like home equity line of credit, auto loans, depository personal loans, what have you. When that interest rate is cut, obviously it makes borrowing a little bit easier for all of us. So mortgage interest rates tend to follow. Again, what we follow more closely is the 10-year treasury yield. But again, 25 basis points, another cut makes it easier on all of us, just the average American consumer in the world. It's fantastic. Now, very good news. Obviously, it doesn't necessarily mean that we're going to see it reflected in mortgage interest rates immediately. We'll talk about that here in a second, but really good news. Why do I keep saying good news? Because again, remember, mortgage interest rates are all about news, okay? Positive news means great things for the mortgage interest rates and bond yields and all of that fun stuff. And we should see mortgage interest rates continue to improve. Bad news, we don't get a rate cut. They don't talk about future rate cuts. Economy looks bad. Jobs market looks bad. Bad is really, really bad for mortgage interest rates and forward-looking guidance, okay? So just remember that when you're talking about or digesting some of this incredibly difficult information, right, when it comes from the world's largest financial market, okay, you need to kind of understand the complexities of that in itself, right? Forward-looking guidance. Good news is great for mortgage interest rates. Bad news is bad for mortgage interest rates. We do not like bad news, okay? So with that being said, okay, 25 basis points to the short-term Fed funds rate is fantastic. But one of the things that Jerome Powell mentioned and talked a little bit about in the presser after the official announcement was the, projection for 2026. I'm going to quickly start sharing my screen here. Give me just one moment while I get that screen pulled up here. We're going to go over here and we're going to go to, here we are. And I also wanted to go here first. Okay, so this is the projection starting for 2026 in the very next Fed meeting on January 28th. January 28th, 2026, and is when we have the next Federal Reserve meeting, okay? You can see here on this tool, presently after today's 25 basis point cut, our short-term Fed funds interest rate is now at 350 to 375. Right over here, you can see my mouse circling right there. And there is a 78, let's call it almost 78, 77.9% chance of there being no rate cut in January in the next upcoming meeting, okay? It's not necessarily a terrible thing. That's to be expected, right? They're only talking about one cut in 2026 in total. So that kind of makes sense, right? We have a 22% chance of another 25 basis point cut. So there's that, okay? But we take over to March 18th of next year. Now we're starting to get a little bit more to the 50-50 side of when that next, and remember, possibly final, again, nobody really knows, but if they're projecting just one cut for 2026, it looks like it may happen as early as March. Okay. Now, before I start digging deeper, because obviously the deeper into 2026 we go, the more and more chances, the higher the likelihood of that next coming rate cut we'll get. But before I go there, okay, just remember the economic climate, especially when you get things like job and employment data coming in, and actually we're delayed with the government shutdown here over this last month and a half or so. Those things will definitely change expectations, sometimes for the positive, sometimes for the negative. So just remember, this is what's called forward looking guidance. And we base all of this stuff off expectation. So it's not Bible, okay? Just make sure that you understand that. Now, as we get a little bit deeper, okay, now we're in April tax season. Now there's a higher likelihood of a cut than not a cut. Okay, you see right here, we have a 44% chance of at least 25 basis points. And then we have a little sliver of meaning that we're going to get a 50 basis point cut, which is, unlikely. So all good there. Now, 2026 should be, heading in the positive direction. We've already been here in 2025 towards the tail end of this year, starting back like August, September. We've had great news, right? We've had interest rates continuing to cool. Things keep kind of creeping down. Regardless if you're in the conventional or the government loan side of things, we're seeing rate improvements. So that's a very, very good thing, okay? When you're already a homeowner, that means as rates continue to improve and you see enough benefit from a mortgage refinance, you can pull that trigger at any time. That's fantastic, right? But what does that mean for the prospective home buyer? Okay, prospective home buyer and these people that you have in the market that are like they think that they're, trying to time the market and time rates and get the low, like it's not a thing, guys. Just, prepare yourself for home ownership. Make sure that you're working with the right mortgage experts, partners, realtors that are going to go out there and negotiate the best deal on your behalf and become a homeowner. Okay. The sooner that you can do that, as prepared as humanly possible, right? When interest rates continue to improve in the future, continue to come down, have different benefits that they pose to you, right? That's when you can take advantage of things like a mortgage refinance. But waiting to buy in the best market possible, first of all, there is no best market possible. It's all unique and specific to the person, right? Because right now, this very market could be the best time for somebody that does not have extra money to pay for their own closing costs, does not have an ability to pay above asking price for things like cash on hand, does not have an ability to compete with other people when it comes to timing and due diligence periods. This market that we're in right now does pose a fantastic opportunity for most people, especially first-time home buyers. So just a little educational piece there. Just remember, time in the market versus timing the market. Time in the market is incredibly financially intelligent, beneficial, and it's the play. You know what I mean? You'll look at any economic advisor, financial expert, whoever you want to talk to, they'll always tell you that time in the market is much greater, supersedes, much more powerful than timing the market. Okay, just remember that. Now, okay, so what does 2027 look like? Let's just, again, just real quick, little snippet. Okay, now in 2027, the most common scenario, okay, is that we are in that 300 to 325 basis point level, okay? Meaning we have now seen from where we're presently at somewhere between 50 to 75 basis point decrease. So that could be fantastic. That means over the next 24 months, we have positive outlook on what the markets look like. That is a fantastic thing. Hopefully when jobs data and economic reports come out here later this week and before the end of the year, it's not super, super bad. Things like the tariffs have already been baked into pricing for the most part. So all positivity heading in the right direction. But what else? Let me real quick here. I'm going to show you guys why this is such a big deal. This right here is actually on one of my specific lenders' websites where they give us market news and analysis on a kind of up-to-date basis during intraday, which means during the day. And you can see right here, right? We had some kind of like negative-ish news very early in the morning before markets opened. MBSs are down. Okay, they're ticking up a little bit slightly. Wasn't great, but as soon as we had the Fed rate cut, announcements came out and all the news came out, you can see we have some positivity and ticks up to the mortgage-backed security market, which is really, really good thing. And then most importantly, right, the talk in the press conference about what's to come. So the markets really like that. We're already seeing some movement in the positive direction. Now, again, guys, remember, this is not huge moves or decreases to interest rates. Obviously, these are all very small, little itty bitty bite-sized positive things. But make sure that you're reaching out to the mortgage expert that's working with you on your home purchase or refinance, kind of understanding how it affects you. But this was actually great news. This was really cool. And it's nice to see some positive movement here for the 10-year yield. Remember, we want to see that 10-year yield where it's presently at right here at 4.152 present day right now, December 10th to 2:27 p.m. Pacific time. We would like to see that push back down because if you guys remember, I want to say it was the last live that we did, if not the second to last live that we did, where the 10-year yield was actually just pushing at the tippy top of 3.9 something and very, very low fours. Okay. Obviously, we've seen it pushed up higher into the 4% range, which is why interest rates were increasing over this last week or two. Okay. Let's see it push down a little bit lower in the fours, if not back into the threes. That would be fantastic. Hopefully, here before the end of the year. As always, I'm going to keep you guys updated every single step of the way. I have a lot of reaching out to do to current and past clients. I want to make sure all of you guys obviously stay top of mind and updated and educated and all of the above. Because remember, guys, I promise you, who you partner with matters. So congratulations to all of us, right? The American consumer for another 25 basis point cut. It's really, really good news for all of us. Our credit cards, our auto loans, our HELOCs, our personal loans, whatever. Let's keep forward momentum heading in the right direction. No bad news here soon. And I will see you guys in next week's live. See you guys next Wednesday. Take it easy, guys.